Hello, everybody. Bob Repass here with another edition of Revolve Capital's Passing Notes podcast. As always, I'm joined here with our CEO and founder, Chaz Guinn. Chaz, how are you today?
Bob, we're back in studio. It's good to not only see you, but be able to talk about what we're seeing in the market and have one of our not only friends in the business, but a really good guest in the business on the podcast with us today.
Yes, we do have a special guest today. Usually it's just me and you in here kind of telling everybody what's going on from our perspective, but we're going to bring in one of our industry experts that we've known, both of us have known for quite a while. So Chaz, why don't you bring on Alex?
You know, we've not only, if you're in this space, but you're engaged with his firms, pulling title, and especially when you're buying a first lien asset that is distressed, whether it's defaulted on its traditional payments or whether it's an active foreclosure, and you're going to assume ownership from a different seller, you need to verify a handful of different things. Just like you were to enter escrow to buy a property, you're going to do the same thing with our guest. Our guest is leading the capital market space today from not only pulling title, but running compliance and running full gamut of A to Z of when you're buying an asset. So we're going to welcome on Alex Goldovsky.
Great to be here. Thanks, Chaz.
Alex,
Bob,
what's up, buddy? How are you, man?
Oh, things are very busy. Right time to be in the notes business.
So before we get into some of the questions, Alex, tonight, why don't you tell us briefly just about the three companies that you have and what those firms do in the distressed debt space?
Absolutely. So my first company that I started in 2008 is ProTitleUSA. We probably own about 65% market share for the capital market whole loan transactions. In other words, whenever somebody buys from Fannie Freddie, HUD, or any bank out there, they probably use my company for tax and title diligence. The second company that I own is called DocSolutionUSA. Whenever you transact or buy a mortgage in the real estate market or buy a property, you have to record the document in the county office. And that's exactly what my second company does. We take the paper and we record it at the place of the property. And the third company is the only AI-based, fully rated CPR firm. CPR means third-party due diligence firm called One Diligence. We're rated by all the rating agencies, Kroll, S&P, Fitch, etc. So all three companies work together. They're well connected, and that's why I'm still CEO of all three, because I treat them as one big umbrella of services to the capital markets.
That's why we have you here, man. You're in the trenches, seeing volume, and you've seen many different markets. You've seen the '08 market. You mentioned starting this thing in '08. So imagine that 4 and 5 year span, even when you and I met back in that day, seeing kind of us crawling out of the space, so to speak. And then, talk about 14, 15, 16, stuff started to balance a little bit better, but then came COVID. Right. And then COVID started leaking in, and then here comes additional headwinds of a rate environment that stayed low and allowed to kind of the market to be propped up. But now we're starting to see massive defaults, not massive defaults in terms of volumes, but there's these pockets that we're starting to see uptick, which now is beginning to seep out into capital markets. That being said, we've seen a lot of alternative investment capital come into the space, whether it's private credit funds, whether it's large family offices, whether it's even institutional players that are in other asset classes like commercial, multifamily, insurance, and now it began to pivot into our space. I'm sure you've seen many different capital stacks and waves coming into our space. Can you talk a little bit through that, just in terms of the evolution of capital you've seen come into the space, and more or less how you have dealt with a little bit of the small, the medium, right, even the larger capital that's come in to the market, especially as of late?
Yeah, so it's a good point. Looking back, Chaz, I actually remember the conference we met in about 2008 or 2009. You were the superstar there on the stage, and I was right there talking to you. But at that time, 2008, 2009, a lot of small, mid-size, and large funds were focusing on the NPL market, right? It's post-GFC crisis. You can buy non-performing notes for pennies on the dollar, 10 cents on the dollar, and then get that reperforming and then sell it close to 100% on the dollar, right? So crazy times, and I think a lot of people made a lot of money there. With the progression to today, right? It's not as simple to make money. First, there's no products out there readily available, and folks are really eyeing alternative investments to different product segments that are pretty active today, right? That didn't exist in 2008. First off, with the high rates, people are holding on to their mortgages, right? So only forced sales are happening on the market. So additionally, it's very hard to qualify for a mortgage, right? Because folks are projecting the prices to fall nationwide, right? It's not just in Florida. And therefore, it's very hard to qualify for the full price on the property. And typically, you get a pretty poor appraisals. So with that said, there's a lot of forced sales in the market and a lot of delinquencies in the selective groups or selective areas of the market. So if you peel the onion today, right, first let's touch on veteran affairs mortgages, right? VA mortgages, there's about 5,000 mortgages that defaulted again after VASP, which was the modification program for veterans, and Trump presidency is not renewing that program. So we should see a lot of the VA loans in the markets. From what I can see, about 15,000 will hit the market in delinquency sometime this year. It doesn't mean they will go to foreclosure right away. I think they'll be serviced. They'll go through the loss-made options through the servicers, but there will be opportunities there. There's about 40,000 delinquent USDA loans. So if you are into buying farmlands, that's a good segment to look into. I feel that this year and next year, you'll see a lot of foreclosures on USDA loans, probably 20,000 this year and 20,000 next year. It could create an opportunity for that segment. We've seen a lot of investment into closed-end seconds, HELOCs, and home equity investments, right? So that's a brand new segment that just popped up. It was pretty low in the course of the last 10 years. And in the past 2 years, I'd say, it's growing significantly. This year, it grew about 18%. So we see the delinquency rates are picking up in that segment. If you're betting that the rates will stay higher for longer, that's a good segment to look into. Just to invest the closed-end seconds and HELOCs, just because you're playing the appreciation game. If you think the rates will drop, probably you don't want to touch that market. And certainly the lack of conventional loans and conventional loan trading created an additional opportunities in different markets for non-QM, DSCR, fix and flip, RTL loans. So those markets, and of course, private money lending, right? So those markets picked up significantly. They're growing rapidly, and every fund out there wants to play in the alternative markets. And finally, of course, we see a big rise in Ginnie Mae delinquency, not Fannie and Freddie. Fannie Mae and Freddie Mac loans are pretty clean based on their last NPL sales. But Ginnie Mae is really stand out. That's the first-time home buyers market. We see about 12% delinquency rate right now. Typically, that market is being participated in with the EBO sales, early buyouts, when the Ginnie Mae liquidates the whole portfolio, the whole pool of loans to a large investor. So plenty of opportunities out there. It's not the same opportunities as 2008, right? It's not as easy to make money. You have to be selective. But like you said, there's a lot of folks getting money on the sideline or starting to participate in the markets that are completely different from those heydays of 2008.
Yeah, I wanted to interject on the Ginnie Mae piece. Most of those loans are FHA loans. And as we know on the FHA product, that's a type of mortgage program that you can get into with the smallest down payment, right? As little as 3% down. So do you think the lack of skin in the game is what's driving some of this delinquency? Or do you think it's underwriting standards have been lessened as far as the Ginnie Mae product?
Yeah, good question, Bob. I think that underwriting standards are much higher than 2008, 2009. I don't think the issue is related to the documents. I think there's a lot of pressure from the job market, from the buying the property at the peak for the first-time home buyers, lack of down payments, credit card delinquency, delinquency on autos. All of that translate into that first-time home buyer issues that really become a headwind to that market specifically, right? So I think the papers are really clean. The mortgages, the documents, collateral, we looked at it from all the firms that I own. There's no issues with the documents as we found in 2008, 2009. The issue is related with the first-time homebuyer delinquencies.
So, Chaz, it sounds like the reasons for default are pretty much what they have been through the years, and it's impacted by the affordability, which you and I have talked about, on previous episodes. So, I think as long as rates stay where they are or close to where they are, and to Alex's point, as far as the job markets, and how that's impacting certain areas across the country, that we're going to continue to see a spike in this particular product. And I know we were talking about how do you scale the firm? How do you position yourself to go from a small to a middle and then up to an institutional size firm? And what are some of the barriers that keep us there? Why don't you kind of elaborate on that and then bring Alex in?
Sure. Yeah, I think there's been drivers we've been tracking. And the drivers have been that the cost of living is continuing to go up, right? But the job salaries are not keeping up pace. So there's a natural gap, we call it a delta, that's being created between what people can afford and what people are earning. And that's really simple math of how it translates into, can you keep up with your monthly payments? Alex brought up affordability on auto. We've seen delinquency on auto up 20% over the last 24 months. So if you're stopping to pay your car payment, that then trickles now into your house payment, there's kind of a ripple effect there. And look at credit card. Credit card is also starting to hit all-time highs. I think there's multiple articles showing that 1.7 trillion of credit card debt. That's well to the height of the peak of 2008 in terms of consumer debt that's been acquired. All of these now are becoming drivers to delinquencies increasing. Alex highlighted USDA, VA, FHA, Ginnie Mae. These are all GSE cruise ships that are operating in lakes. They don't move too quickly, right? And now you're starting to see the ripple effect of that product hitting the mainstream. We've seen these small to medium-sized players in our space. Could be managing anywhere between 30 to 100 million of capital, right? Managing anywhere between 3 to 1,000 units across the country, having good regional teams to be able to manage that in somewhat of scale. But now we're starting to see more institutional capital coming into the space. Alex, why don't you highlight a little bit the upticks when you start seeing loan counts increasing? Do you start seeing your normal players in the space doubling down and acquiring not twofold, but really starting to uptick the acquisition volume as delinquencies begin to carry themselves out?
Yeah, exactly. So good point. And the biggest indicator for me is the dry powder on the market, right? Whenever I start seeing my clients who are large funds on Wall Street starting to securitize their existing assets, it means that they're refinancing their portfolio and putting the dry powder to the side to go and jump into the market. So if they're doing that, it's a good indicator that more delinquencies are coming, right? Additionally, just to point out one more thing that we didn't talk about is during Biden presidency, a lot of the COVID-related mods were just kicking the can down the road. Under Trump, you only have one bite at the apple, right? No more COVID mods. They get canceled in September, right? So you only have one chance to do a mod, probably a trial mod within 3 months, and that's it. You have to find a job. You have to go to work. You have to figure out how do you pay the mortgage and get the income, right? So that was another sort of headwind that we see right now as far as the view of the market itself. And coming back to the players, right? So all the big players are on the market right now, right? So there's usual suspects that I'm sure that you read about in the news. They're bidding on the same pools, and the pools are getting larger, right? So there were very little product last year, very little product and activity during the rise of the interest rates because the market was in shock. And now it seems like everybody's coming back, and folks that are trading all the time and are on the lists of winners for Fannie, Freddie, HUD, Hack'em pools, etc. They're on the market right now. They're hungry. They're bidding against each other, and it's the biggest guys typically win, right? Where the cost of capital is low. There's a trust level with the large players. It's very tough to get the mid-sized players to play on the same level because typically they complain more, and the smaller guys, they complain even more, right? So, and some of the bigger players don't want to hear complaints, right? It's all or nothing. You buy the whole pool. It's $1 billion transactions, and that's how the transactions are happening today. In fact, I can tell you that in the first 2 quarters, we hit the record revenue across the board for the transactional volume. What does it tell you? It means that the trades are out there. They're happening on some of the larger big fund space and not mid-size and small size. Even though big size and small size funds are still playing, it's not as regular as the bigger fund space, 1 billion or 500 million plus.
Well, it sounds like you just outlined a recipe of jacking the price up on a lot of these trades, right? The big boys are just bidding against each other, which basically means they're just paying up. They know if they're going to get this huge chunk of assets in their portfolio, that they're going to have to bid against 2 or 3 other counterparties, and they're going to have to drive that price up. And Chaz, you and I see that from how can you play in that space? How can somebody pay that much, for assets? And we're trying to push all we can to get into the game as far as the GSE product. And let's really focus on our discipline to our model, but yet trying to stay aggressive enough to be in the game. And we're finding it tougher and tougher over the last 60 days as some of these trades have come to market.
The great point, because for us, that's where we've been able to have our niche, Alex, especially even with you, is kind of staying more of a sub-billion-dollar player in the space. We are able to curate portfolios that the bigger boys are unable to because it's a taken all or nothing, where we're able to look at a subset of assets and be able to kind of narrow down that population through different buy boxes that get us to a good population. However, you're starting to see the delta we talked about earlier regarding the borrower behavior, but what about the deltas between loan balances, call it a UPB, and the total collectible balance on the asset? So you stopped paying in 21, job loss, health, divorce, something happened to cause you to default, and now 4 years later, you're still in your home not paying. You've been doing bankruptcies, loan mods, nothing's been able to stick. Now you're back to paying on a consistent basis or not even answering the call at all. So now there's this delta between what you stopped paying in 21 and what you owe today in present times. So that delta now has kept a lot of guys saying, look, we can pay almost par of that old balance, but there's a delta we're going to go for between the time they stopped paying and where we are to present. So we are seeing it get rich, Alex. The question's going to be is, because of so much dry powder that's been on the space, we've seen a lot of mid-size and smaller size players getting pushed out of the space. Not pushed out, but getting outbidded, right? Because there's candidly cost of capital that is aggressive, that is able to put out dollars that one may seem like, look, it's going to be tough to make money at those levels. But talk a little bit through what you've seen, not only historically when levels start getting pushed up and up and up. Do you see those players outlasting some of that price hike, or is it more of just a stranded play of securitization, right? Am I buying the asset for a securitization play? I can bid it up just to get into the game more or less, and then say, look, I'm going to treat this as a bond and get out of this in a few months or a year anyhow. Like from your standpoint, when you're running title and diligence and even implementing automation to AI, what are you seeing some of the strategies playing out for some of these guys?
Yeah, so you just mentioned a few keywords, right? One is the game. Well, I would say that note purchase is a game, and you need to know how to play it, right? So there's other ways than just the purchase price to make money on the NPL transactions. That's why my company is doing so well on the tax and title, because we find all the potential discount requests that are missed during the sale, which maximizes the discount to the seller. And certainly there's a number of products to do so. The other point that you made, securitization, right? So for a buyer, securitization is one of the exit strategies. If you're a mid-sized player or small size player, you don't think about those things, right? Securitization is call it a refi to allow investors to buy into your fund, right? So bigger players, they have a good process to securitize the loans on the Wall Street, right? To get the money back, whatever they spent plus, right? So they make their carry, they make a significant return. They tend to shoot for maybe 10 to 12% on the fund. Some of the funds lately are getting 8% because of high bidding, as you mentioned. But that's the exit strategy, right? It's very important to know that some of the bigger players can go ahead and securitize the loans, refinance, get their money, and invest again, right? So smaller players cannot do that. Final point that I wanted to make is partnering with the bigger players, right? If you're a mid-sized fund or small-sized fund, outside of investing into bigger player fund, you can probably team up with a bigger player that has a capital to deploy. And in many cases, there's a set-aside pools. There's a pools that you co-bid. Probably that's a high chance of winning on the market, right? So from my perspective, there are strategies you can still apply as a mid-size or small size to participate in the market. But you're right, bigger players, they are just sweeping the market all or nothing. And their level of diligence is phenomenal. It's a well-oiled machine. Plus, they estimate that they'll make money on converting the NPLs to RPLs, just like it was always the case, right? Making the spread, as you mentioned. You can make money on the foreclosures. You can make money on didn't lose, on flipping the properties, cash for keys. So there's many strategies that are all ironed out, and they existed since 2008, and now it's even more effective. And you can make more money with the workouts and exit strategies than before, right? So there's price models that you can plug in to see if you can bid a little bit higher, maybe match some of the bigger players. Otherwise, you really have to play with them and potentially partner up.
We're joined here today with Alex Goldovsky, CEO and President of ProTitleUSA, DocSolutionUSA, and One Diligence LLC. And I want to remind our audience to like and subscribe to our podcast so that you'll continue to hear from the industry experts that we have on. And Alex, as we mentioned at the top, we've known you probably since 2008 when you started ProTitleUSA, and I've always considered you to be right on the cutting edge of wanting to implement technology. And that's one reason why I know you went out and acquired DocSolution and started One Diligence. The point you were making about the various ways to tweak your model to maximize your exit strategy, whether it was NPL to RPL or through foreclosures, how have you been able to use technology, maybe specifically say AI, going forward? Are you going to see that embraced more by investors, or do you see some barriers as far as growth in that area?
Thanks, Bob. Good question. And there's no turning back on AI, right? AI is here to stay. It's not a hype anymore. Before it was a hype. Oh, AI will change the world. AI will do this. And nobody knew what AI was. To me, AI is very mathematical approach to a task. In fact, I would like to claim that in the next, I'd say 3 years, for every 100 jobs, only 5 will stay. And 95% of the jobs will be done by AI in the banking and finance industry. That's my claim. I I'm a practitioner, right? So I know all the technologies that you have on the market today. Some are great, some are overhyped. And I can tell you that last year, I participated in the Small Business Administration survey, and the results came back. How many businesses deployed AI, not the email AI, not the open AI, but employed AI or deployed AI into their business, and it's only 5% last year. Okay, even though you had 50,000 AI startups that were doing something with AI, and only 5% of those startups actually survived. Why? To do something with AI, it means that you are deploying a tool or a widget that costs you pennies to do a job, right? But to develop it, it'll cost you a few $1,000,000, right? That's why AI startups typically don't survive. But if you insert the human in the loop, which is something that a lot of the AI startups are missing, will give that human review element that will confirm that the data is 100% accurate, right? If you remember before, there was an OCR, there was a computer vision, a geometrical boxes that you zoom in. This is all very old technologies. Everything that was built 3 years ago, it's old now. It's really old now. The technologies that you really need to pay attention to are Claude, OpenAI, or I hope you don't use the DeepSeek by China. But those are the current technologies, and we currently use in our business 7 AI technologies. What did it give me and my businesses? I'll give you a quick example, right? So when you look at the underwriting of the loan and checking all the documents, you typically deal with a 10,000-page document stack that it would take a human to review about 8 hours. We can now underwrite a loan for creditor compliance, either newly originated to the guidelines or seasoned loan in 45 minutes. It's phenomenal time saving. In fact, people that didn't believe me, we had a demo with them and ran the loan underwriting on the fly. You can extract all the data points from the notes, from the mortgages, from the appraisals, from the application, and just focus on things, or at least in CDs, right? All the fees are auto-extracted now. And you only focus on mismatches and exceptions that the human would still need to review and verify if they're real or not. That's it. That's the task now. It's not underwriting the file, it's reviewing exceptions. So the machines are so smart now that you throw any type of documents. It takes only 2 hours to train for anything new. It takes 5 days to train for any data points to be extracted. And then you're ready to deploy the machine in completely different workflows.
But we've needed it. The space has been so behind in terms of fintech,
Yeah.
right? We've been wanting the space to come in and say there's a lot of manual work going into underwriting a file, physically touching it, where this could be scanned and reviewed and done within a matter of hours per se. To your point earlier, that 8-hour example, I mean, Alex, that just imagine that person never took a lunch break, right? Never got sick, never left their desk, right? So call it a couple of business days that now is taking 45 minutes. One thing we're starting to implement, I'm curious on your take on this, is we're using it today on our current system, our platform, our off-the-shelf database that's getting fed from all of our different servicers and our different vendors that help us real-time oversee these assets. What we've better to understand is what rule set can not only we give them, but that they're rolling up to us to eventually teach us behavior, right? We want to be able to understand when a loan or a decision needs to be made on a file to advance it forward and not leaking out days or weeks that happen to be able to make a decision more fast. Are you seeing AI in your businesses where it now can kind of help kind of surface a behavior that person, that human that oversees the AI can now advance the process to its next step?
So in my mind, this is all rule-based, right? So what you described is is nothing else but writing a rule on what criteria you want to apply for borrower behavior or the property or the servicer flags. All of that is a workflow rule based. It's not necessarily AI. So you can potentially feed the guidelines and things that you want to do as far as flags, bells, and whistles, but this is very easy, right? So this is you train the LLM for it. But to take actions on what to do, to produce something that is actionable, I think that's a job of the AI, right? So in other words, you have a rule that will generate something, an email to the borrower, and then, once the borrower responds, you do something. So that can be easily done by a AI bot, right? Front-end AI bot. My AI is really implementation of anything related to the documents. So review of contracts, credit card delinquency, auto loans, any real estate loans, any government documents, healthcare. So you name it, whenever you have the documents, that's where we excel. We train our bot or our AI engine that will read, understand using NLP, right, natural language processing, the documents, figure out what to do with it, create the versioning, verify if it's signed or not signed, notarized, not notarized, recorded, not recorded, and then apply it in the right method for the guidelines check or for credit and compliance, and give the results to the human to review, right? All of the stuff that I just described, it's all under the hood, no human, right? That's where the savings are coming from. It's the no human reviews that are given by or are driven by AI.
And that's what's fascinating, is that in real time, what you're doing right now is overseeing billions of dollars of assets that is being implemented real time on this. So, a lot of skepticism around what adoption AI will take in one's business. Well, here we are. And this is kind of why we're bringing voices like this to the podcast.
Yeah, Chaz, the exciting part is it gets us out of the weeds. Alex said that all you would have to do is look at the exceptions. Right. So then you start making executive decisions, right? You can make the determination of whether to proceed with a trade or not. You don't have to spend hours just going down a rabbit hole, digging through all the weeds to see what you have here. It's going to save so much time, so much energy, really, right? And the resources are going to be right there at our fingertips. So it's very exciting. Before we let Alex go, I want him to do a little bit of a prediction here. So Alex, in the news, we're hearing a lot about the possible privatization of Fannie and Freddie. First of all, do you think that may actually happen? And if it does, do you think that will be a good thing or a bad thing, especially for those of us that are in this space?
It's a good question. It's a very common question. So I participated in a conference called Executive CEO Roundtable in Washington, D.C. And I had the pleasure of talking to Mark Calabrio and Julia Gordon. So it's a prior FHA director and a current FHA director and somebody who oversees Fannie and Freddie. In that conversation, it was very clear, right? So Trump priority for Fannie and Freddie exit is probably number 4 or 5, right? So passing the tax bill is number 1, ending the war is probably number 2 right now. And, number 3 will probably be Fannie and Freddie. Their target, based on what Mark Calabrio said, it's going to be close to 27, 28, right? So the plan is there, but there's a big if. If midterms will keep the House and Congress Republican, then we're going to see the exit. The means of the exit is already determined, right? I think Guggenheim created a structure where it'll be implemented through the sovereign fund, wealth fund. Sovereign fund will purchase the Fannie and Freddie stocks, and then they'll dilute it to sell to the private sector, right? So the means of conversion, Fannie and Freddie is there. So the only thing is the timing, right? Diluting shares will probably be against something that Bill Ackman would want as a big investor in both. But at the same time, the dilemma for Fannie and Freddie is If they become privates, they have to justify charging more for securitization by Fannie and Freddie in their pools, right? So if they are more expensive than Rocket or UWM, they have to reduce operational costs in a way where they stand out, right? So that's why we hear about title waivers in Fannie and Freddie. That's why we hear about automation. That's why we hear about efficiency improvements, AOLs. These are all in the effort to reduce operational costs during the origination. So you have to cut down origination costs to justify that extra 0.5% that originator would need to pay. Otherwise, they'll just go to Rocket or UWM because they're in the private market. There's no difference where you securitize and whoever pays you more money to get the loan to their pool. Right. So from my perspective, I think the method is there, how to do it. The timing is there. It's 27, 28, but it's big if remains, right? So in my mind, it'll happen. So if I would be looking at the crystal ball, I would say, I think it'll happen. If we see an improvement in war, it'll become higher priority than the war, and certainly it'll expedite things.
That's some great insight, Alex. We appreciate it, and we'll hold you to it and see if that prediction comes true. And we kind of feel like that 26 midterm will probably be the turning point on what happens and when. So we appreciate you joining us today. And again, bringing us really some deep dive into what's going on in the market, what's going on with various GSEs and the products that are out there, and the impact of technology and AI. So Alex, Chaz, and I want to say thank you, and we appreciate having you, and we'll talk to you soon.
Good seeing you, brother.
Thank you, guys.
We'll see you soon.
All right.
Take care.
So Chaz, that was some interesting conversations, but it seems like somewhere in the conversation, it always falls back to affordability, right? We were talking about the various products, the various spikes, the VA, the USDA, the HELOCs, the FHA, and that's where a lot of the delinquencies are starting to spike, and it all boils back to the affordability. We talked about credit cards, we talked about autos, but I wanted just to wrap up this episode with just taking a real life example on, and you and I have talked in the past about what does it take to buy a home these days? How can someone afford it? All right. Well, the recent stats just came out, and I wanted to kind of go over those real quick with you and kind of get your input. So right now, the median home price in this USA is $431,931. So let's just call that $432,000, the average. Now we know back in your old neck of the woods in California, it's way higher than that. And then maybe in Alabama, Arkansas, it's a little bit lower than that. But the median home price is $432,000. So a regular conventional mortgage wants 20% down. 20% of $432,000, $86,000.
Sure.
Right? I don't know about you, but a lot of people sitting on $86,000 are only going to be the ones who already own a home, sell it, take their equity out, and have the money to put down. The first-time home buyer is not going to have $86,000 in the bank, most likely.
With you.
Right? So they're going to go to the FHA route, which we talked about. You can get in with a minimum 3% down. Right? So what is that? That's still right at $13,000. That's a big chunk for a first-time home buyer. Okay, so $13,000. You have that. Now you get a $419,000 mortgage for your first mortgage. That sounds great. Well, the rates are 7 for 30 years. You're looking at a payment of $2,787.
Right. Goes back to our DTI issue.
Exactly.
Right. Now you're starting to creep up to that 48% level, where now that's greater, almost half my income is going to my payment, one blip away. So I'm following you. Keep going. All right.
Well, everybody says, well, the Fed has to lower rates. Okay, well, we all know when they lower rates, they don't lower them by 1 or 2%. They usually knock them down a quarter, maybe a half. All right. So let's look. If the average mortgage rate went from 7 to 6.5 in this same scenario, right? 6.5, 30 years on the $419,000 mortgage, your payment is still $2,648. That's only a savings of $139 a month.
Nope, not feeling
Right?
that.
So you're only saving $1,670 a year.
I know where you're going.
So where do we have to get to? Not to mention how long it'll take to get there at a quarter.
It's what we've
or
been
a half.
saying. You know what
How
we've
are
been
you going
saying.
to give down?
It's got to touch fives. We have to have a 5 in front of that number for anybody to actually make a move, especially on the purchase side, but more importantly, especially on the refinance side. For anybody to sell their home today, I mean, we already know 6.5 to 7 loans out of every 10 today has a 4% rate or lower. So why am I going to refinance out of that rate environment and get myself into a 7% rate environment? It makes zero sense. So I would think, though, you do begin touching your refinance market if, in fact, it starts having, 5 3/4, something of that nature, where now you're starting to incite behavior to say, you know what, we could maybe cash out, right? Take some of this equity, go buy a home, and or maybe do some renovations to my home. But I don't think you're going to see any real movement on borrowing behavior until a rate environment goes down another 150 to 200 basis points, which would touch a 5% rate environment. But so I hear your point. Okay, now what my take on this would be is affordability, and we talked last episode about this. The average savings is sub $1,000. So if you've put $13,000 to borrow down and to buy your first home, and you now going into a job environment that's not increasing jobs in the private sector alone all that much, and job increases in terms of salary take-homes are not keeping a pace with inflation, right? So something's got to give here where how can I still get into this environment, which, as we've talked about before, this breeds, we want you to rent. I don't necessarily see an environment that says we're inviting you to buy or we're inviting you to start tapping into your home equity. We already know there's trillions of dollars of equity sitting with the borrower today that they're not tapping into because of the rate environment is so high.
All right, and we only talked about the bare bonus to get into this house, $13,000. We didn't talk about reserves for taxes and insurance, reserves in case your income doesn't continue to go up, right? I mean, you need to have like 20 grand.
Thank you.
Just laying around so you can put your money down, keep some money in escrow, and fight to live another day, so to speak. So I think you're right. It needs to be a 5 handle on the rate. However, at a quarter or a half point, maybe in the last 2 quarters of the year, next year, I mean, we're looking at a year, 18 months at best before you can get down
Right.
there at the current move that
Which
we're
is
going.
why Alex's business is spiked, which is why he's having record transactional volume, which is why he's doing billions of dollars in deals, is because the environment is up. Delinquencies, affordability is a macro headwind that is being faced by millions of consumers, that is being dumbed down by the war, being dumbed down by prior protests that are happening on coastal environments. This is wild, right? So we're starting to see an environment that says, look, if you're looking at our alternative investments, especially in our space, Bob, as you know, when you start seeing headwinds, the doubling down in our space begins to occur. Right, a lot of folks begin to pull their foot off the gas just because you don't know what's going to happen with rates and environment. And for us, it does the opposite. Right, so it's always been kind of a push and pull with our environment. That's why we're hearing for ourselves record transactional volume. That's why we're starting to see our trade volume, not only on sales but acquisitions, it's doubled. Right, and I think it's because of the environment that we're in. So, interesting point. Yep. Good point, man.
Which has another great episode. I think Alex brought some great industry insight. I hope folks will go back and watch the entire episode and just kind of dig into some of what he said. And again, if you want to learn more about Revolve Capital, go to revolvecapital.com. You can sign up to be a individual no buyer or find out more about our passive investment funds. And we'd love to have you hit us up there, revolvecapital.com. And Chaz, another great episode. I always enjoy it. And folks, this has been another edition of Revolve Capital's Passing Notes. We'll see you next time.